Hey there, business owners and tax enthusiasts. Welcome back to our channel where we simplify complex financial topics for you. In today's video, we're diving into the tax-free conversion of a partnership into an S corporation. If you're currently running a small business as a partnership or an LLC treated as a partnership for federal tax purposes, and you're considering converting to an S corporation, this video is for you. Let's get started. First, let's talk about why you might want to make this conversion. One of the primary reasons is to reduce exposure to Social Security and Medicare taxes. In a partnership, each partner's share of net income is fully exposed to the self-employment tax, which is 15.3% on the first $147,000 of income for 2022 and 2.9% above that. For shareholder employees of an S corporation, however, the FICA tax only applies to salaries, not distributions. This can result in significant tax savings. Now, let's go through the process of converting a partnership into an S corporation step by step. The first major step is to execute a Section 351 incorporation. Under Section 351 of the Internal Revenue Code, you can transfer the business assets, liabilities, and operations of your partnership into a C corporation, and this can be a totally tax-free transaction or mostly tax-free. Here are the key requirements for Section 351 treatment. 1. One or more persons transfer property to the corporation in exchange for its stock. 2. The transfer must be solely in exchange for stock. 3. The transferors must control at least 80% of the stock immediately after the transfer. 4. The transaction must have a business purpose. 4. If these requirements are met, the transaction can be tax-free. However, if boot, which includes cash or property other than stock, is received, taxable gain may result. The taxable gain is the lesser of the gain realized or the amount of boot received. Also, if the new corporation assumes liabilities that exceed the tax basis of transferred property, this counts as boot. After completing the Section 351 incorporation, you can turn the C corporation into an S corporation. Here's how. Your new corporation can elect S corporation status by filing IRS Form 2553. For the election to be effective for the initial tax year, file Form 2553 no later than 2 months and 15 days after the beginning of that year. If you set the conversion date as December 31st, the initial tax year starts January 1st, and you should file by March 15th. If you miss the deadline, don't worry. There's a relief procedure available where you can show reasonable cause for missing the deadline, allowing the S election to take effect on the intended date. Now, let's talk about the different ways you can structure a Section 351 incorporation. There are 3 main ways to structure the incorporation. 1. The partnership transfers its assets and liabilities to the new corporation in exchange for stock, which is then distributed to the partners. 2. The partnership distributes its assets and liabilities to the partners, who then transfer them to the new corporation in exchange for stock. 3. The partners transfer their partnership interest to the new corporation in exchange for stock, which automatically liquidates the partnership. Each method has different tax implications depending on the basis of the assets and the partners' interests. Finally, let's discuss some key points to keep in mind and the filing requirements for S corporations. Only domestic entities can elect S corporation status, and an S corporation cannot have more than 100 shareholders. All shareholders must be individuals, certain trusts, or estates. Unlike partnerships, S corporations cannot make special allocations of tax items. They must be allocated strictly according to stock ownership. Corporations must file an annual federal income tax return on Form 1124S and issue a Schedule K-1 to each shareholder, who then reports their share of the corporation's tax items on their personal tax returns. In conclusion, converting a partnership to an S corporation can offer significant tax benefits and streamline your business operations. It's a complex process, but with careful planning and execution, it can be done tax-free. If you need more detailed guidance, consider consulting a tax professional. Thanks for watching. If you found this video helpful, Don't forget to like, subscribe, and hit the bell icon for more tax tips and business advice. Leave your questions in the comments below, and we'll see you in the next video.